I want to switch gears and bring in my next guest, Larry Swedroe, another old friend of mine. I got a lot of old friends here today. Larry is the director of research at Buckingham, Buckingham, and of course the author of a new book, Enrich Your Future: The Keys to Successful Investing. Larry, before I start, I just want to ask you about gold here, because George just came off here. Your quick thoughts on gold and gold investing in general as a diversifier.
A few quick things. One, gold, a lot of people use it as a hedge for equities. A 2012 study looked at how gold performed in equity down markets. And it's not a perfect hedge, but it has gone down 17% of the time when stocks went down. So it doesn't act as a great hedge in that way, but 83% is not a bad track record. But in 07, 09, when we had the big financial crisis, gold fell 30%. So that's a problem there. On the inflation hedge side, I don't see how anyone could consider gold to be a good inflation hedge over any reasonable horizon. A good example, 1980, gold hit 850. In March of 2002, it hit 293. In that 22-year period, inflation was 4%. So gold fell 86% in real terms. So I don't think you can really reasonably say gold is a good inflation hedge over any investor normal horizon. The last point I'll make is I think gold can act as a hedge against geopolitical risks. And right now we're facing a lot of them, including, I would add, the deteriorating financial situation of the U.S. with its massive budget deficits, now looking more like, say, Italy, and heading in that direction. So you could see, as your guest mentioned, more central banks moving away from dollar reserves, and that could put upward pressure from demand from central banks and maybe other investors who have been traditionally used the dollar as a safe haven asset. So that's a potential plus for gold.
All right. And I want to go back to the book now. So you start out with a fairly long digression on what matters in investing. And you note that a very small number of factors explain most of the variance in stock returns. I'll put up a screen here, but you talk about size, value, momentum, profitability, quality. Just briefly note what we're talking about here. Here's coming up on the screen here. Explain some of the variations, because you start out with why do some stocks perform differently than other ones, and I think that's important to note here.
Yeah, I think the best example, and my book is filled with stories and analogies to make difficult concepts easy to understand for people who haven't taken courses in capital markets theory, which means almost all of the population of investors. So you can think of it the way sabermeticians figured out that batting average wasn't the key statistic to tell you who was the best hitter for a team. It included on-base percentage and slugging percentage. So you had different metrics. So the academics have applied the same idea to try to figure out which metrics help to determine the future stock returns and have provided premiums in the past. And what they have found for equities, there are 5 key metrics. One is what's called market beta, which is your exposure to the overall market. Some stocks have more exposure, they're more volatile. Some stocks have less. The second is a size factor. Smaller companies have provided a premium over large companies over the very long term. Value stocks or cheap stocks have provided a premium over growth stocks. More profitable companies have provided a premium over the less profitable ones. And Warren Buffett's maybe favorite factor would be quality, which includes profitability, but also looks at things like financial strength, stability of earnings, limited debt, those things. And those 5 metrics explain almost 100% of the variation in returns of diversified.
Right. You mentioned Warren Buffett. You've got a great chapter on Warren Buffett's secret, and that is, while he is a great stock picker, it's the fact that he has exposure to quality as a factor that matters. It turns out, after he got involved with Charlie Munger, he was one of the great quality investors here. Chat about that briefly.
Yeah, so Warren Buffett was generally considered the greatest stock picker of all time. And what we have learned in the academic research is Warren Buffett really was not a great stock picker at all. What Warren Buffett's secret sauce was, he figured out 50, 60 years before all the academics what these factors were that allowed you to earn excess returns. Cliff Asness and the team at AQR did some great research and showed that once you accounted for the leverage Buffett applied through his reinsurance company, if you bought an index of stocks that had these same characteristics, you would have matched Buffett's returns virtually. And so now today, every investor can own through ETFs or mutual funds the same types of stocks that Buffett has bought through companies that apply this academic research, companies like Dimensional, AQR, Bridgeway, BlackRock, Alpha Architect, and a few others.
Yeah, so just moving on here, you're very adamant that two things that don't explain performance in the stock market is individual stock picking, which doesn't work, and market timing, which you talk about, again, trying to go in and out of the market doesn't factor. Neither factor, you said in the book, leads to long-term success, particularly when accounting for the time people put in, the costs, the taxes.
Yeah, that's true with one minor exception. Momentum certainly is a factor that has worked over the long term, although it does go through some long periods like everything else where it will underperform, but momentum does work. But that's a mechanistic, non-active management. It's purely systematic. Computers can run it. You don't need to pay big fees, and you can access it with cheap momentum funds run by some of the same companies I mentioned.
Yeah, and Todd, we've been talking for years about index investing. One of the reasons ETFs went out is essentially this research that Larry has summarized in his book is one of the main reasons that the ETF business has been so strong. It is mostly index investing.
It is, and we talked about some of those factor-oriented strategies. So there are a number of ETFs that either are single factor specific, like QUAL is an iShares quality ETF that's focusing on those characteristics that was talked about: strong balance sheets, consistent earnings, low leverage, and you even have ETFs that combine some of these factors together. So GSLC is a Goldman Sachs ETF that combines quality and value and momentum all within one portfolio. So we're seeing growing demand for factor-oriented ETFs. We are also seeing demand for actively managed ETFs, despite some of the data that shows it's hard for active management to consistently outperform.
Yeah. And Larry, there's another great chapter, one of my favorites actually in the whole book, is on the similarities between sports betting and stock picking. So you make the point that you don't hear much about rich gamblers, but you do hear about rich bookies that are going on. And it's the bookies that actually end up making the money in sports betting because how highly efficient it is.
Yeah, so I actually think this is the most important chapter in the book. I searched for a decade to figure out a way to explain how markets are actually setting prices. And the best analogy I came up with finally was looking how sports betting works. And everybody knows it's very easy to identify the better team. For example, if Connecticut, which won the championship in the NCAA last year and might win it again tonight, is playing Arkansas State, we all know they could play 100 times and Connecticut will win. But it doesn't do you any good betting, because the market puts odds or a point spread and says if Connecticut doesn't win by, say, 32 points, betting on Arkansas will allow you to win. And the point spread is exactly analogous to a PE ratio or a book to market ratio, and in the sense that great companies are going to have much higher PE ratios, much higher market to book value prices, in the same way that Connecticut is going to have a big point spread over Arkansas. So it does you no good to know which is the better team. And in my view, and all of the research shows that it really does you no good to know which is the better company, because the market already prices for that.
Yeah. So what's great here, and again, this is the best chapter in the book. My favorite chapter is you point out that the real object of the game. What's the game we're all playing? The object of the game is to keep everybody playing, because the bookie wins as long as everybody keeps playing. Stock brokers and active managers win as long as everybody keeps buying into stock picking. So the more you play, the more likely you are to lose or underperform. Essentially, this was one of the main points in the book, in your chapter in your book there, right?
Yeah, because they're taking the vigorish in the same way that if you go to the roulette wheel in Las Vegas, and Wall Street needs you to trade a lot so they can make more money on bid offer spreads. Active managers make more money by getting you to believe that they're likely to outperform. And every year, like clockwork, despite the fact that every year active managers say this will be the year when active managers will outperform, there is never a year when active managers in aggregate outperform. In fact, it's virtually impossible mathematically for that to happen, because they just have higher expenses, including higher taxes. They just need you to play. And so, that's why they tell you active management's a winner's game.
We were just talking with Todd about indexing and ETFs. You've been a big backer of investing in indexes and exchange-traded funds. We know 90% of large-cap fund managers underperform their benchmarks after 10 years. This is the annual S&P 500 S&P
Before
Spin
taxes,
study.
Bob.
Yeah, even before taxes. You're right. Look at these numbers here, folks. 10 years, 90% underperform. They underperform, as you note, Larry, because of higher costs and the fact that the market is extremely efficient, essentially.
Yeah, that's exactly. Active managers don't underperform because they're dumb. They underperform simply because the competition is so good now. It's actually getting harder and harder for active managers to win. I point out in the book, Bob, coming out of World War II, 90% of stocks were owned by individuals trading their own accounts. That means when Warren Buffett was trading, 90% of the time, there was a sucker at the other side of the trade who he could exploit, who was less knowledgeable. Today, 90% of the trading is done by big institutions, including hedge funds and really top world-class academics. Physicists and world-class mathematicians are hired by these funds like Renaissance Technology. And that's who Warren Buffett is now competing against. And if you run a factor analysis on Berkshire Hathaway, you'll find that Warren Buffett has not outperformed in the last 15 or 20 years, where he outperformed dramatically before that. And that's because the market is caught up, discovered his secret sauce, and exploited it. But so some of those factor premiums have shrunk, but they're still there, and every investor can access them through these lower cost, tax efficient, factor-based strategies.
So what he's saying here is that what used to be alpha, Warren Buffett, for example, is now what, beta, right? I mean, it's essentially,
right.
Is that the way
That's
to describe
exactly
it?
Right. It's different betas, Bob. So we have a beta of market beta, we have beta of size, we have beta of value, beta of momentum, and beta of profitability and quality. So if you look at ETFs like Goldman's factor fund, it has exposure to those 5 factors, but a very low level. You can use a great website, Portfolio Visualizer, to see the level of exposure, what's called the loading, while fund families like AQR or Dimensional have much higher exposure to those factors in general. So it's important to know that every small value fund isn't the same, even if they're all, quote, index or systematic strategies. You want ones that give you the most exposure, the highest loadings relative to the cost. So you have to look at both factors.
Yeah. So we get to the essential issue here, which is why is it so darn hard to beat the market. I mean, one of the points you make, and you brought up this great study, that only a very small minority of stocks outperform in any given year, and it's impossible to pick which ones will. There's no persistence essentially here, and then there's the lack of persistence in outperformance. Funds that randomly outperform for some period, say 3 or 4 or 5 years, attract momentum investors, but the outperformance doesn't persist. They don't keep outperforming for many years. Yeah. This is a simple way of describing it, but I think I got it right, Larry.
Yeah, absolutely. And for those interested in the subject, I wrote a book co-authored with my friend Andrew Birkin called The Incredible Shrinking Alpha to explain why it's getting actually dramatically harder to outperform, even though active managers predicted that if indexing share went up, which has gone up dramatically from about 2% 30 years ago to some people think as much as 50% today, 20 years ago, or now it's 26 years ago, when I wrote my first book, 20% of active managers were outperforming before taxes. By 2011, that figure was down to 2%. And given for taxable investors, active management, the highest cost is taxes, it's probably half of that. And the issue is the markets is just getting more efficient because the people you need to exploit, which is basically dumb retail money, who chase and invest on emotions and recency biases, they dramatically underperform. In fact, they do so poorly, they underperform the very funds they invest in because they get stock picking wrong and market timing wrong. They get both wrong. And so there is some ability for active managers to win. The problem is 50 years ago, 90% of the market could be exploited. Today, it's a much smaller number, doing much less trading. And therefore, there's just not enough of them to exploit to overcome all their expenses.
And so let me get to another point here that people bring up, which is picking individual stocks. You had a separate chapter noting that owning individual stocks is very, very risky. I covered this study last year as well, that study of 64,000 publicly traded companies. One of the biggest studies I've ever seen. It goes 30 years, 1990 to 2020. And it looked at 60,000 companies all over the world. 2.4% of the U.S. listed companies generated all the returns in that 30-year period. Outside the U.S., only 1.4% generated all of the returns. So owning indexes, essentially what you were saying in this chapter, captures returns from those outperformers, and reduces risk, essentially.
Yeah, I've looked at, there's similar studies in the U.S. that goes much longer back. And they show 4% of all stocks provided the excess return above T-bills. You have to think of what are the odds that you could own just those 4%. And the problem is, while the market has a standard deviation of 20%, any one individual stock is roughly double that on average. So you're getting the same expected return on average of the market, but you're taking twice the risk. That to me doesn't make much sense, especially when we know how efficient the market is. It's not perfectly efficient. There are bubbles that happen from time to time. Today we may have a bubble in what was once the Magnificent Seven, although that's already being corrected, as no one calls it the Magnificent Seven anymore, since a few have dropped out already.
Yeah, I would just add that what we've seen is investors adopting this approach. We've seen the most popular ETFs in the first quarter of 2024 have been these low-cost S&P 500 index-based strategies. So Vanguard 500, VOO, or IVV, which is the iShares version, or SPLG, which is the State Street ETF. Those are among the most popular ETFs. So many more investors are moving into the ETF marketplace using these low-cost, broadly diversified ETFs. That's an extremely encouraging sign to us at VettaFi.
Just quickly, Larry, because we're running out of time, you're a pretty good market watcher. How do you feel about the markets right now? I mean, in terms of like how the market's priced, we know it's priced high on a valuation basis. I think it's something like 20 or 21 times forward earnings. What does that tell us? What is a high price market,
Yeah.
assuming it is high price? Tell us.
Two quick things. One, there are two markets here. We're bifurcated. The U.S. market is very highly valued historically. On average, when PE ratios are this high, future expected returns are much lower. However, the rest of the market is, especially small value stocks that are quality oriented, they're trading as if we're in a deep recession already. A good example of the funds I own, like Bridgeway and DFA and Avantis, their small value funds are trading at single digit PE ratios. And the same thing we see is also true in international emerging markets. So there you have higher than expected future returns. My guess is that the likelihood is we'll see a reversion to the mean of longer term returns, but we can have long periods where high prices can even go higher.
Yeah, and that's a little disturbing because we've been waiting for this mean reversion for a long time, Larry. I mean, we know the literature, we know the academic literature. Small cap tends to outperform big cap over long periods. Value tends to outperform growth, and yet small cap and value have, with the maybe exception of 2022, underperformed for years and years and years. How is there something wrong with the research, or what's going on?
There's nothing wrong with the research. The empirical data is what is. The problem is with individuals who don't understand that a decade, when it comes to returns, is basically what an economist would call noise. You can go, for example, 40 years, Bob, from 69 to 08, and the S&P underperformed long-term treasuries. That's 40 years where that happened. And there are 3 periods of at least 13 years where the S&P underperformed T-bills. 29 through 43 is 15 years. 66 to 83 is 17 years. 2012 is 13 years. The only answer to that is diversification, so you don't happen to own only the wrong asset at the wrong time. That's why you should stick with a globally diversified portfolio. You may want to have some value, some growth, some high profitability, some quality, depending upon your ability to deal with this noise and what's called tracking error or tracking variance. But you should not end up being a performance chaser. That's how the average individual ends up underperforming the very funds in which they invest. You need a very long horizon.
Yeah, 40 years is a long horizon. That's a long time. 10 years is a lot to ask for people. 40 is a really long time.
That's what you would have had to wait for the S&P to outperform long-term bonds, Bob.
The final point here is, what should investors do is stay diversified, stay in low-cost index funds. That's basically the message.
Or systematic. A lot of ETFs are not index funds. They're systematic. They define their own universe. There may not be an index, but they may say we buy the smallest 5% of stocks with the 10% lowest PEs and the 10% highest profitability. I'm just making that up, but there's no index that replicates that.
All right.
You want systematic, replicable, and transparent.
Great. We've gone a little long, folks, but as you can see, this is a very dense topic. Larry has 50 years of covering this, and he's an old friend, and I urge you to get a copy of his book and read it.